Good morning and welcome to the Killik & Co podcast for the 12th of May. Quick look back at last week, and what we saw was an equity market that broadly tracked just a touch easier. Really the key feature last week was the European Central Bank. Again, no change to policy, nor was it expected, but in the post-conference question and answers, some mixed messages coming out from President Draghi, initially tending to sort of remain quite coy about the group's intentions on any further action. Later in the session, he mentioned the sort of readiness to act next month, and that initially sent the euro, which was heading towards 140 against the dollar, quite sharply lower, where it's remained ever since. But post that, and really in the post-mortem to that event, still a great deal of uncertainty as to what he clarified that day and what intention that has on the market. So we'll take a look at some of the European bonds. Let's take a look at this week, and for UK investors, it will be all about the Bank of England inflation report, which is due up on Wednesday. Quarterly, the Bank of England lays out its full report. So a good read on the website, but expected to be one of the most important quarterly inflation reports being seen for some time. What we have seen with interest rates markets is that the level of expectations when rates would start to firm, and indeed when they start to normalise, is being brought forward all the time. It coincides with very strong data from the UK economy that is consistently now being upgraded to north of 3%. So again, we'll take a quick look at the chart of short sterling futures, which maps out market's best guess of where rates are heading. Let's take a look first of all then at the diary for this week, and we have corporate results. Those again highlighted in black are ones which we expect to be commenting upon. Compass Group on Wednesday. As a business, this company is largely driven by overseas earnings, so this higher rate of sterling will undoubtedly have a translation negative effect on their numbers, but underlying trade has been strong, and as I've mentioned before, markets tend to be looking through currency adjustments at this stage. National Grid numbers on Thursday has avoided much of the political sensitivity around energy prices as being the sort of grid rather than supplier into the home. Centrica themselves are going to be under some pressure this week at the shareholders meeting, particularly in relation to the recent series of profit warnings, the last one being driven by the warm winter that we've had, which reduced power demand. So a number of companies coming out for this week. On Thursday, back to Europe, Eurozone GDP for Q1. Again, there has been a feeling that the European economies are showing some signs of slightly stronger growth to consensus, and we'll be talking shortly about a couple of stocks which we expect to benefit from that trend. Let's just take a look at some movements in the bond markets, because really, if we've seen one major change to expectations, it's where longer dated interest rates are moving. There has been a feeling, and as highlighted by a recent Bloomberg survey, that over the next 6 months yields are moving higher, albeit in the near term yields are actually moving lower. That is true of the US, where we can see here the yield running around 2.63, very much towards the low end, as you can see, of the recent trade for 2013, 2014, or certainly the second half. Same is true in Europe. This is that remarkable chart of the Spanish yield, which is now sub 3%, which has down from a high of 7.5% since the height of the crisis. We've also seen the yield on Irish 10 moving now down to lower levels than seen in the UK, and that's the first for some time. For a situation very true of Italy as well, back below 3%. So really the demand for European bonds continues at pace. This volatility, this was a very short dated chart which I'm showing, which is the euro versus the US dollar for last week, and you can see really that strengthening expectation that we saw here nudging towards 140 on the ECB meeting last week and the post-action, and really this was the impact that the Draghi's comment had on the market, and you can see that he managed with one comment to move that market back from 139.50 to trade 137.71, so taking a little bit of heat out of the euro currency, which is incredibly important for its development or sustainability of its recovery programme at the moment with exports. Turning back to the UK, this is the chart that I wanted to show, which just maps out between May 2014 and March 2020 of the pace of UK interest rates. Now, this is an inverse chart. It effectively works with a base of 100, and the lower that number goes, the higher the base rate on interest rates. So you can see here base rates being very much towards the sort of 0.5%, but moving down towards 3.5% on rates by March 2020. Really the key number is March 2015, indicative pre-election in the UK election of a 1% interest rate, and let's just see how that marries up with the Bank of England's quarterly inflation report due up on Wednesday. Just finally, I want to sort of re-establish a couple of names that we highlighted recently as good buys for the European marketplace. Linde AG, which is the company that bought BOC in the UK, industrial gases. We like as a business. They had some good numbers. You can see the share price sort of rallying towards the highs there around 148 of the recent trends up to about 150. Still like that stock, still feel that's a very good play for European growth. And also we, a slightly more specialist company, but a €2 billion market cap company, Duerr, which is the supplier of many of the robotic services that the automotive industry uses. So good growth for automotive growth. Then recent numbers were very good and well received. Again, that share price sort of starting to move up. So both those companies we should be commenting upon, and if we'll have research notes on for you to read if you're interested in taking those ideas a bit further. Just finally, posting an anticipated announcement for Dixons this week, and the merger with Carphone Warehouse is anticipated to be announced this week. They've been in talks for most of 2014. Apparently a deal largely agreed between the two, and this could see the inclusion of Carphone Warehouse stores being included within all the Dixons operations. They currently have a tie-up with Phones for You, but plenty of synergies potentially to come out of this merger on the high street.